The past doesn't predict the future. Is now a good time to buy real estate? The answer is, where is the best place to buy real estate?
Super excited to be bringing you Reventon's own podcast, the Reventon Property Podcast, to do everything with real estate. We're going to bring some experts, finance, real estate, anything to do with residential. We thought we'll start off with a very, very special guest, our old COO with us for 8 years. Now he's a managing director at Hotspotting, who's also a partner affiliate of Reventon's. Tim, welcome, mate.
Thank you so much for having us.
I haven't been here for a week or two, so it's good to have you,
exactly.
mate.
You're knocking over buildings and all sorts of things. I didn't recognise the place.
And obviously also joining us is our head of sales and Lachlan. Now, so Tim, where's a good place to start?
Oh, look, I suppose it's the start of 2026. Should we go back and see if we've learnt anything from the past couple of years?
Probably a good place.
All right. So one of the things I've been talking a lot about recently is the fact that markets are cyclical. You know, in all my years of doing this, I think the people that do the best in real estate are people who understand market cycles. And if we go to 2024, December 2024, Perth was the leader at the time, 15% capital growth that year. Way down in 0% was Darwin, and even further behind that was Melbourne at -3%. Right, so the interesting thing about that is that's an 18% spread from top to bottom. You had the same interest rates no matter where you were in the country, the same prime minister, wars breaking out. Donald Trump still had control of his Twitter account, but it's an 18% spread in the same country. So it goes to show that where you own real estate is very important, you know. So we fast forward 12 months down the track to the end of 2025, and the leaderboard looks a little bit different. Perth was still the leader at 17.4%, but Darwin has gone from 0% to 14.5%, almost a market leader. And then Melbourne has gone from -3% in 2024 to now positive territory of 4.5%. And what we learned from that is that Melbourne's well and truly into a recovery cycle. So I think that's a pretty good place to start moving into 2026.
Now, we always talk about research and obviously the property clock, 9 o'clock emerging market and all these signals. And it's very, very important to look at a holistic view all around the country, because a lot of people that look in their own state, it's going to be good at some time, but other times it's not going to be. So when you have a portfolio, it's good to be looking into Victoria, Tasmania, Queensland, and going around. So we've had our clients over the last, how long have you been in our 6, 7 years? How long have you been?
5 years now.
5 years.
Yep.
We've gone to how many different states since then?
A lot of different areas. So 100% markets are all cyclical. And the property clock's something that Reventon keeps a really keen eye on here. And there's 3 growth trends that we really focus on when we're looking at new areas to invest. The first one and the most important one is what we call CAGR, which is compound annual growth rate. So that's the growth rate over 10 years annualized. So an average area tends to grow by 5 to 5.5%. We're looking for areas that are typically 6.5% plus. And that shows it's got a great track record of long-term capital growth. So that means even if you don't time the market perfectly, you're going to perform pretty well. The next one we look at is the 3-year growth rate. We don't want to buy, Tim's touched on how well, places like Perth have done. We don't want to buy in an area that might have seen 50, 60% over the last 3 years, because we talk about the cycle. It is a fair way through its current cycle. So we're looking for areas that are a similar price today than what they were 3 years ago. And in some cases, actually a little bit cheaper, because then you're getting in at a good time. But we do still want to make sure that the 12-month growth rate over the last 12 months is positive, because as you know, you don't know you actually come off the bottom of the market until we start seeing that growth. So we do want to see there's some positive direction in the prices in the last 12 months. Equally, last 3 years, we've seen a drop. You're not paying too much of a premium on what others have only a few years ago. And then we've got that CAGR showing long-term track record of strong capital growth.
And what we discussed before we started rolling with the cameras is in some areas you can see new builds that are actually cheaper than to buy an established property in that area. Yeah. And it also offers you the maximum tax benefits as well. Good way to get into the market and start building your portfolio. And if your house is cheaper than what's selling, it gives a good opportunity for it to grow as well.
Yeah. So I think there's a couple of things in that. There's cycles in terms of location, and we often say that the location you buy in is going to do 80% of the heavy lifting. And a lot of people start out going, okay, well, I want to build a new home, or I want to buy something established. But I've always suggested if the location does 80% of the heavy lifting, look at that location and then start to work out, is a new build or an established property a better option in this market? Because there are markets around the country right now where you could build a brand new home cheaper than what's selling in the local market. And why wouldn't you do that if you get the stamp duty savings, the structural warranties and things like that at the end?
It's interesting. A lot of people talk about new build or established, which sort of confuses me a little bit at times, because all the established properties were new builds at one point in time, weren't they? So as you said, I think the main thing is buying in the right area. That's going to do most of the heavy lifting for you. Then it's about getting the right type of asset. Now for us, it's about finding properties that are going to suit owner occupiers when you go to sell further down the line. Families who are going to be prepared and able to spend a bit more money.
Because it opens the pool of buyers.
Of course.
Opens the pool of renters as well.
So whether you build it yourself or you buy something someone else built 10, 20, 30 years ago, we don't think has a massive difference. It's just coming down to that whole supply versus demand piece. We don't want to be building in areas where there's going to be a lot of supply of land over the next 5 or 10 years, because it becomes very hard to see long-term capital growth. So when we do new builds, we are looking for more of those boutique infill sites. Might be 20, 30, 40 blocks around established infrastructure, and that allows you to get the best of both worlds.
I think it's a good point. It's a good segue, actually. We've been talking a lot about real estate data and the metrics around real estate, but there's so many things outside of that actually drive real estate markets. And we often say, when you're looking at real estate data in a rearview mirror, the past doesn't predict the future. So what we want to be thinking about is, what are those forward-looking indicators that are going to show us this market's about to move? And a lot of the time, that could be economic data, demographic data, infrastructure investment.
Migration.
Yeah, all of that that's going into an area. And those are the things that are actually going to drive real estate markets more so than what the historic data says.
You look at all these things too. You look at, obviously, walk scores, the public transport, where the Costco's are opening, because they're spending how many tens of millions of dollars on research to see where the migration is going, where the population is going. I mean, the government spending infrastructure. That's a very, very strong pillar.
Yeah.
Also shows good growth for jobs, both contract and then permanent roles, because as they're building schools, shopping centres, whatever the case may be, it's going to create a lot of work there as well. But I know that you spoke a lot about, I know a fellow colleague, and especially of yours, of Terry Ryder, talks a lot about different sub-markets and sub-regions. So people are fixated on the median house price.
Yeah.
But all that is group them all together and average it.
Yeah.
But as you said, if there's an 18% spread, why is this a plus 16? Why is this a minus 2? And if you understand those indicators and you see what's going on, you're going to have a better opportunity to predict that area. So unless you unpack that, very, very hard to know what sub-regions are doing and how they're going to outperform the market.
Yeah.
But more importantly, why they're going to outperform the market.
It's interesting on the subject of medians, when we talk about the national average, you're looking at anywhere between 6%, 8% that have happened in the last 2 years, but that is the median across. We've got 15,000 suburbs here in Australia, and you've got, housing market and then unit markets within that. So there's a lot to choose from. But there's also, we're a very big country. So you're going to have a look at, the median price of all of those tiny little townships and all those sub-markets. And of course, 6 to 8% is quite an average return. But if you go and say, well, listen, get rid of every market within Australia that hasn't had at least 50 sales in the last 12 months, and that median jumps up. Well, there's actually 4,500 suburbs that had above 10% last year. And it goes to above 20%.
What a difference.
What a difference. But it goes to there was 550 suburbs last year that had over 20% capital growth. So it goes to show, if you actually start to say, well, listen, when I'm doing my research to identify markets that would be that have substance, simply go and remove all of those tiny little outliers that have tiny sales volumes. Look for locations that have got a minimum 15,000 population. And instantly what happens is you take this huge amount of suburbs and markets of house and unit markets, and you start to dwindle down to something that's a lot more manageable. And that's what we start with. We say, let's get rid of all the noise, dwindle it down to something that's actually got substance, and then you can start to pick where the markets within the cycle.
Because it does skew the data.
Absolutely.
Exponentially. But unless people understand that, they're just going to look at the median house price, they're going to look at the average, and they're not going to know all those things. That's why it's always important to do your research, to speak to companies that have a track record in picking areas and that understand forward indicators.
Yeah.
What's going to go on? You're never going to see a Costco, a Bunnings, go open in an area that there's not a bunch of jobs created or infrastructure. That's not going to happen.
No,
they're not going to spend all that money. So that's always a good indicator.
I mean, choosing the location is one thing, but then there's subsections within that location as well. Like Melbourne's a really good example of that. So started 2025, we started investing heavily in Frankston, which a lot of our clients weren't thrilled about at the time. But we looked at Frankston and we looked at the median house price there, and you look at all the median house prices, all the suburbs around it, and you just knew that it needed to grow at some stage. So, I mean, we were getting people into 3-bedroom homes on solid land allotments for about 750,000 at the start of last calendar year. By the end of that calendar year, we were getting valuations back over 900,000.
Yeah.
It's almost 20% growth in Frankston in 2025, which was great for our clients. But you look at a lot of other parts of Melbourne, most parts of Melbourne did not see anywhere near that that amount of capital growth. I mean, some of them were lucky.
That's a great example of infrastructure investment as well. A $2 billion hospital, creates a lot of jobs. It creates a lot of high incomes in the area as well that can support that wage growth.
Yeah, and it becomes a big difference when you look at areas that people never would have invested in years ago. I remember, this is showing my age, but before Caroline Springs became what it did, and working down the street 25 years ago. Now, I wasn't the property runner at the time, the person who shows the property, and he had a 4-bedroom home in Caroline Springs for 195,000, and he had a 1-bedroom apartment in Hawthorn, same sort of price. It was about 210.
Mm-hmm.
And the client, there's no way I'm going to Caroline Springs. There was no infrastructure, no ring road, no nothing. And the property consultant goes, I'm happy to sell you whatever, but on one condition. They said, what? You just got to come out with me and just come down the journey with me. He took them to Caroline Springs. They barely had the freeway, and he showed them exactly what was going to go on all the schools. And as you know, Caroline Springs has become I don't know how many schools are in that area, shopping centres. They bought that property for 195, and now they're at least $1 million. In that area, but he understood the infrastructure going. Yeah, the 1-bedroom in Hawthorn would have maybe doubled or from 200 to 500. Yeah, that went to $1 million with better rental yields. Same sort of thing because it was greenfielding. Yeah, same
we
thing
often it's a similar topic, but we have a thing we call real estate snobbery. And that is the real estate snobbery. So, people often look at, a great example was the northern suburbs of Adelaide. That's now been one of the strongest performing markets in the country the last 5 years. But, go and drive through that area 5 years ago and be quite easy to say, well, I'm not buying here. But it's one of the reasons at Hotspotting, we actually don't put in the socioeconomic scores and crime rates into locations because we truly don't believe that they have a connection between capital growth and those two items, crime rates and socioeconomic. Yes, it's important to know. I'm not suggesting for any reason that you want to go and buy into a dive area. But what is important is that if you look at that data and you go, well, listen, socioeconomic indicators are a little bit lower, that doesn't mean it won't grow. They're actually some of the best performing markets because affordability was key over those years.
And gentrification changes.
Yeah, it happens.
When people start to move into an area, then you'll see the cool cafes pop up, the little shopping strips pop up. Everything
so it's
changes.
important to understand what's coming as well as, I suppose, the takeaway there.
Well, the data's consistently shown over the last few years that affordable price point of the real estate markets, outperformed the more expensive price points quite heavily. And it's because
money flows to where value exists. That's the key.
That's where all the demand is. And obviously we just had an interest rate hike and we're not sure where that's going to go. But if interest rates do continue to go up, it's the affordable side of the market, which we think will continue to perform very strongly and won't be so susceptible to where interest rates are.
It always has a ripple effect as well. So one area that's doing very, very well, when people can't afford that area and there's usually land there, they'll migrate to the next area. The build might go up a bit, but the land will go up, so the price will kind of stay similar. That's what happened.
Interest rates is a great topic, right? It's demanding the headlines at the moment. There's a lot of clickbait. Every time we start to see any sort of interest rate rises, the bank economists jump on and start making predictions about, the property markets crashing. And I just don't know how some of these bank economists keep their job because every time they do this, they get it wrong.
But it's clickbait, though.
It is clickbait. But still, you've got to stand by your forecast, and they're just constantly getting it wrong. But the point is that what they don't understand is that interest rates play not that they're not important, but they have a very small
one factor.
Yeah, they have a very small influence on property prices, especially when the things that are underpinning real estate markets here in Australia right now is undersupply, lack of listings, and the migration numbers.
We were talking about that yesterday as well on our podcast, and we said people don't take a balanced view. They fearmonger on interest rates, but we're still on undersupplied. We've still got the migration coming in. There's so many other factors that are driving it, but it's people sit back.
We spoke about Perth before, and we've had a lot of clients over the last few years that have had amazing results in Perth, and all of that growth happened through that interest rate.
Through the
cycle.
spike. Yeah, that's exactly right.
But it's all the sub-markets, though. It's understanding that. And it's only one component. We spoke about it extensively because people are only worried about rates, but there's so many other things to consider.
Yeah.
Undersupply is important.
Well, undersupply is probably the number one
driver.
Number one driver. Yeah, exactly. So if we look back over the last 10 years, Australia's population has increased by 4 million people. We've got 50% less houses for sale right now on realestate.com and all these other platforms with more people. And there's about 30% less rentals available as well. You guys will know the answer to this question. What is the industry standard for a balanced market in terms of vacancy rates?
Industry standard?
Industry standard, what do they say is
about 2%?
About 3%.
3%.
3% is what the standard is, right?
Sure, that's what I was going to say.
When do you think we had a national vacancy rate above 3%? The last time we had a vacancy rate nationally above 3%, which is what we call a balanced market. 2 decades.
Yeah, it'd be a while ago.
Over 20 years. But yet we've just been talking about housing crisis and rental crisis in the media the last couple of years, but we haven't had a balanced market in those terms for over 2 decades.
Well, it's interesting sort of segue. Obviously, there's a little bit of talk in the media at the moment around potentially a change to the capital gains tax discount here in Australia, which surprises me a little bit because obviously there's already a lack of rental properties available for people in a lot of parts of Australia. And you think bringing in that sort of policy may lead to even more people selling, which once again is going to shrink the pool of rentals and only push rents up here in Australia.
Yeah.
I mean, what's your view on all that, Tim?
Well, look, this is a consequence of the undersupply here is a consequence of just years and years of really bad policy, really bad government spending, not putting attention on actually doing anything to actually build up the supply. They do a lot on the demand side, very little on the supply side. And, right now we've got this, target to build, 1.2 million homes, which started as 1 million homes. And then for some ungodly reason, they decided to up that and get a stretch goal of 1.2, knowing they were never going to hit the million. So we keep on falling further and further behind. But we've got so much debt in this country that, the federal government's going, where do we claw back some of this money? And the first people they go to every single time is real estate owners,
investors
right?
owning,
So on the capital gains front, one of the things that policymakers never really understand is the unintended consequences of making changes like this. And Victoria is a great example of that. You go and put in, introduce land tax. You go and start to make 114 different changes to rental legislation in favour of the tenant in most cases as well over the last few years. And, investors, they vote with their money. They say, if you don't want my money, I'll sell up and I'll take it elsewhere. Yeah. And that's what we saw over the last few years here in Victoria. And at one point, I think it was midway through last year, there was 10,000 less rental properties in Victoria than there was 12 months earlier. It just happened to coincide with the same time that the government actually stopped the level of student migration coming in as well. So had they not done that, we would have been in dire straits here. But on the CGT front, one of the things that, because I sit on the national board with the Property Investors Council of Australia, and we've been invited to, talk on that conversation. One of the things that we would be happy with is to say, well, listen, what we want to be able to do is get rid of the speculators in the market, the people that are coming in, buying a property that could have gone to a first home buyer. They're picking up for 500 grand, spending 50, 60, 80K on it, reno and picking up 150 after selling it after 12 months. If they keep it for the 12-month period, they get a 50% discount on CGT. We've suggested maybe you could make that a 10% discount year 1, 20% year 2, 30%, 40%, stagger it like that. And what it'll do is get rid of a lot of the speculation going in the market. And I think that's a fair outcome for protecting homeowners.
That is a smart policy.
Because what we want is investors in the market coming in and adding to the rental pool. I mean, at the end of the day, we supply 90% of the rental properties in Australia as it is. But that's what we would say would be a fair way to adjust the CGT.
I mean, most investors only have, one investment property?
72%.
Everyday Australians trying to get ahead, create a nest egg for their retirement. And,
But you did mention, when you said policy, look, you can only go back, it's a long time ago, but you look at when they brought in capital gains tax. They grandfathered the existing properties that were owned.
Yeah.
So in most cases, for people that own property, you'd like to think whatever legislation or policies in now, they're grandfathered it, and it will change moving forward. But regardless for the investors that are sitting on the fence, should I do it, should I not, get in the market, make a decision, buy real estate, and then roll with the punches, because the longer you wait speculating, what if that doesn't happen?
Yeah.
But if it does, two things that I say to people that wait, and it's not timing the market, it's time. You're not timing the market, it's timing the market. You've got to get into the market to wait to then make your money. But two things that will never change: people are going to pay tax. They're going to have a shortfall in retirement if they don't take action. So you still need to get into the market and do something. If policy changes, you've got to roll with the punches.
The funny thing about CGT and other taxes is the property investor is always written up as the devil in this equation,
course,
right?
Yeah.
We get all the tax breaks as the property investor. Well, that's obviously their attitude towards negative gearing and things like that. But the truth be known, if you want the best tax deductions, it's actually a homeowner. It's an owner-occupier who pays no CGT upon the sale. So it's an interesting take. I mean, people often talk about negative gearing like it's a handout. It's not a handout at all. It's actually, you're paying it back at the end. It's just a moment in time. It helps you afford to keep that property.
But when you wealth for the interim,
exactly.
But you become self-funded though. It's a win-win though.
Yeah, that's true.
So the government's giving you something now to become self-funded retiree because they won't have enough money in retirement. So although it might seem like whatever it is, you're going to pay it back, as you said.
Is the CGT discount not to take into account inflation as well? Like when you look at...
No, it's 50. So after the 12-month period,
yeah,
you minus your cost base. So let's say you bought it for 500 and you had 20,000 cost. So it's 520. You sold it for $1 million. 480 will be your gain. After 1 year, they'll give you 50%.
I understand that. I'm just thinking with inflation though, like if you buy a property for 500,000 and you sell it for $1 million, and you look at inflation through that period of time, should that not be taken into account?
Well, a lot of things should happen, but it doesn't. And it becomes more. I guess it becomes a lot more convoluted, confusing. I mean, it's the whole idea of buying investment properties is to become a self-funded retiree, and throwing policies around. They're going to do this, they're going to do that, they're going to add this tax and add that. It scares more people to get in the market. And half the times these policies don't change. And when they do put in a policy, they should they should get rid of one.
Yeah.
They should simplify, not make it more complicated for investors to get in the market.
Yeah.
If there's a shortage in houses, if we need to build more, shouldn't they encourage investors to be buying these properties to allow for renters to rent them as well?
That's right. I think it's really easy, especially in our circles, to think about real estate as the asset class. But you're a massive ambassador for the homeless problem here in this country, and right now per capita it's worse than the US. It's really easy to think about housing as an asset class because we're helping people grow their wealth through it. But first and foremost, it's actually a dwelling that is providing accommodation for someone who needs it. And the thing is, the government is constantly trying to tax the people that are supplying 90% of the rental properties providing that housing. I mean, we're not the devil in this equation.
And you made a good point. Like, as you know, we own a property management arm and they make it so complicated, so much legislation. Then for your team to be up to date and compliant, that takes time, it takes money. They're making it harder like they did with a lot of financial services. Another great example is financial planning. Yeah. They made it so difficult, so compliant that people are just leaving the industry. That's going into the too hard basket.
I had an event that we hosted for property investors recently on behalf of Picker, where people could come and sort of talk to us about some of the challenges that they're seeing in the market. And one of the guests at the end, when we had the Q&A, they stood up and they said, "Tim, this minimum standards that they've introduced, it's not minimum standards on housing, it's minimum standards on rentals. They're telling me my house needs to meet this compliance, but not on my own home where I live. Why is it okay that I can live in those sort of conditions, but my tenant can't? So I can't afford to spend any money on my house at home to make improvements because all my money is going to my investment property."
That's a very good point.
Yeah.
What was your response?
Oh, no, I agree with him. I mean, we actually advocated against some of the compliance around the minimum standards, and we did have some wins. Some of the things that will still get introduced in the future, no doubt, but we had them delayed because we're just not ready to make those changes. And the most recent things you guys would see this having a property management business, but not being able to advertise a property before it meets minimum standards is causing all sorts of dramas because when are you meant to get if you're getting a vacant possession, you've got, a week or so that you'd usually not have tenants. But now I've got to get the property, I've got to be able to get trades through the house and spend all this money to get it up to date. So it does make, and this is a really good point for, the viewers at home watching this as well. When you're thinking about your real estate purchase, you're not just thinking about, is that a good buy anymore? You're thinking, how do I make sure that this is going to be compliant in the quickest time frame for me to get tenants in place?
How do I sell it? How do I make money? How do I add a tenant?
If I can tie that back to what we were talking about earlier, it's why a lot of our investors do choose to go with a new build option, because they know that they're buying a property that on settlement will have no defects, it's going to meet the compliance, and it's going to be able to be rented out straight away. Low maintenance costs, and typically they get a little bit of higher rent from the tenant as well. The cash flow and that sort of thing tends to be a lot better on new builds.
Or when you speak to an investor and you say to them, as a tenant, would you prefer an old house or a new one? People are going to pick new.
I was speaking to our property management team actually yesterday about this, and they were saying if you get two properties side by side, one's brand new, never been lived in before, the one next door is 20, 30 years old, same bedroom, same bathroom, same size, same street, the new build's going to get about $30 to $40 extra per week in rent. Over a year, what's that, 1,500, $2,000.
15.
Not to mention that the owner of that property is being able to get a lot better depreciation. That same property sold 12 months later. Second owner comes along, even though there might be 6 years worth of depreciation of fixtures and fittings, we're no longer allowed to claim that anymore. That was a legislative change with the ATO probably 4 or 5 years ago now. So we can't claim, we can claim the building over the 40 years, but the fixtures and fittings is first owner only.
Yeah.
So you look at all these things. We've been in the industry collectively for, we're looking at probably 45 years here. And the legislation is constantly changing. Everything's been reviewed. It's so important to go to someone who's actively investing, that's actively doing research, and that's actively helping investors get in the market. Otherwise, it becomes so difficult.
Yeah.
And I heard you say this a lot of times. We make a complicated process simple by putting the right professionals in place, by going to the right builders, by doing the right research, because there's so many components that you need to consider before pulling the trigger. But when you do, you can keep
It's
going.
funny, it wasn't that long ago where there was still a lot of investors in the market who self-manage their properties. You would be absolutely mad to try to do that now. Like, it is impossible to keep up with compliance.
And if you think about it, you go to an agent, 7-8%. Oh, it's such a small amount of money, which is tax deductible, and it's hassle-free. Imagine having 3 properties, 5 properties. All of these things are deductible, and having a good agent, I think, is having a good broker and a good agent is paramount to you being a good investor, a successful investor. So you need to find a good company. But manage my own property, I couldn't think of anything else.
Oh, God, no. Not a chance.
So with the research, Tim, what would you say to an investor that's on the fence, thinking of getting into the market? What would you say to them?
Look, I mean, it's the old cliche thing that, is now a good time to buy real estate? The answer is, where is the best place to buy real estate? To give you some context behind where the market is today and moving into 2026 and beyond, Terry Ryder's been doing what we call the Price Predict Index since 2012. And essentially what we do is we monitor sales volumes as a bit of a precursor to growth. And what we do is we look at every suburb in Australia and we give it a ranking. Is it rising? Is it declining? Is it plateau? Whatever it may be.
Sales.
And then based on that, we say, within each location, so each jurisdiction, which there's 14 of, there's 8 capital cities and 6 regional markets. And we look at every one of them and we sort of group the positive rankings versus negative. When we did this for the summer Price Predict Index heading into 2026, it's the first time since he started this in 2012, we don't have a single market in Australia that has got any negative rankings.
I was going to say that. I was looking at the data.
I've never seen it like this.
The last quarter of the calendar year, from September to December 2025, all markets went. First time in my 5 years at Reventon that I've seen all markets growing at the same time.
It wouldn't have been the first time in a long time, but it's gone back to the start of the conversation. 16 minus 2, there's 18% spread.
Yeah.
If you look at a 4% growth rate difference, a compounded, that makes all the difference in the world to your wealth.
100%. So
your first, second,
you
third,
talked about,
massive.
Time in market, which is obviously incredibly important, but if you can get both. So if you can time the market and buy in a rising market, get that growth very quickly, you're back in the market.
But you can get both.
You can get both.
We've seen a ton of our clients get both because we've researched it and we've put a good strategy in place and it's robust. We do our 6-month reviews. You can get both, but you need to go to someone who's got a proven track record that's in today's market. Not that was good at this 20 years ago, because the legislation's ever evolving. I mean, it's hard for us to keep up with them. This is what we do all day. Imagine someone who hasn't been in the market, but there's a lot of good companies like yours that do research But you can go down a rabbit hole when you go do too much research.
Oh, absolutely.
And people don't act. They
Yeah.
become paralyzed from too much analysis by paralysis.
Yeah, exactly. So one of the cycles that we've been talking about at the moment, Victoria is like now in a place where it's, as an investor, it's hard to ignore just because we're nothing if not affordable. Like compared to a lot of other markets around the country, it's it's hard to ignore. Even with the land tax and even lower rental yields, it still comes into to play now. And one of the markets we've been noticing, I was talking to Lockie about earlier today, is the Geelong market. The Geelong market, you can, in a lot of cases, buy cheaper than replacement cost in the established market. We've seen this huge amount of growth since 2015, and then it sort of plateaued for a little bit. Well, actually, probably more than plateaued, it declined for a little bit because of all of the negative thing that was happening in Victoria. But now you could be buying properties below previous peaks. And what I like about markets like that is that they've already proven themselves. They've proven they can get to that. You're buying at 50, 60, 80K below that. So we know we can get back there. And then with the momentum that we're seeing here in Victoria as well, I think that's going to be a really strong market to watch.
You look at Waikato, look at the infrastructure around.
Yeah.
So there's so much money spent there, so it's already established.
But every time we see those, the cost of living pressures, and we start to see some interest rate rises, that's when those regional markets start to pick up as well, because that people are looking for the affordability in their lifestyle.
We started investing back in Geelong about the middle of last year. One of the areas in Geelong that we really like is Lara. It's obviously very close to Avalon Airport. There's a lot of infrastructure going around that part. It's also the Melbourne side of Geelong, so actually not too far from Melbourne. People actually live and live there and work in Melbourne. But with Lara, I actually had my first portfolio with a review with a client yesterday. We helped them buy a 4-bed, 2-bath, double garage house in Lara on about 700 square metres in June for $730,000. So we had their first portfolio review 6 months from settlement, and we got a bank valuation at $820,000 for that property. So $90,000 worth of growth in 6 months. And this is an area that isn't slowing down. This is an area that's actually going to quicken when it comes to sales price growth.
Yeah. But the other thing is that a lot of the challenges we're seeing around the country right now is a lack of listings. And when there's scarcity in listings, it's hard to buy well. Yeah. Geelong was also representing opportunity because there was more listings, which means a bit more competition for vendors. It makes it a buyer's market, for lack of a better word. So that's the opportunity where you can not only buy maybe below valuation price in some cases, but you're also buying, below previous peaks with that upward momentum of sales activity. So I think it's an exciting market to watch.
So, even if the property market's booming, it's hard to find good stock. When the stock's easy, it's hard to find sales. There's always something going on. There's a lot of tenants, there's no tenants. That's why I say to people, you just got to get into the market. You got to invest, you got to find good areas. Don't worry about one aspect. Interest rates are going up on where to get into the market.
You'll always find a reason not to buy.
Yeah. Correct. But don't borrow the maximum amount. If you can afford 800, borrow 600. Make sure you're comfortable. Get in the market and then duplicate that process. People are fixated on one component. Oh, there's no supply here. There's interest rates gone up. Get in the market. Action is probably the most important thing now. We can talk real estate for hours and hours. It's come to that time. Boys, quick fire questions.
Ooh.
First thing that comes, Locke, I'll start with you. Buying in a trust or personal name?
There's a lot of sort of red tape with trusts now. Personally, I'm more of a personal name. Get the tax benefit.
Same question. Look, I think there's benefits to both. I think if you're a business owner, it makes sense to put it into a trust because it's asset protection and things like that. The challenge is that if you're not in a business environment and you're just working for wages, you're going to lose the negative gearing by doing that. So I'm personal name outside of trust.
Asset protection is very, very good for trust, depending if you have a company. It makes more simple and makes more sense to buy in your personal name. Get the right advice because what's going to suit you is different. Capital city or regional?
Obviously, it depends on affordability. The main thing for us is buying that family house. If you can't afford that in a capital city, then go to the regional town. But capital city is obviously preferable.
Yeah, no, I'm a regions all the way, to be honest. I mean, there's certainly very, very difficult to be buying in capital cities that, in the affordability mark where you're getting good rental yields now. So in terms of how you can scale a portfolio much faster, I think the best way to do that if you're starting out is the regions.
Affordability is king. I'd say regional, unless you've got a massive portfolio and you've got a different strategy. But you can find great assets in both locations. Yep. Fixed or variable rates?
At the moment, I would probably go variable myself.
Yeah, variable.
Look at the 3-year fixed rate, see if it's higher than it currently is or lower. That's a good indication where they feel the rates are going. So the answer might be You might fix and vary it, speak to your mortgage broker, or call Reventon. Land size or location?
Both are equally important for mine.
On location. I think land size in a lot of markets now is less as important as it used to be. You look at all these master planned estates and things like that. You've got access to a lot of parks and things like that. Unless it's land that's usable where you can subdivide, having a bigger backyard is just more maintenance to me.
It's more of an expense. I agree. So location, lifestyle suburbs or greenfield?
Probably lifestyle suburbs.
Lifestyle suburbs.
Look, I'll say greenfielding because there's more opportunity to make money. But again, it depends on your strategy. It depends on where you're at your current cycle. Buy interstate or stay local?
Well, in my 5 years here at Reventon, we've pretty much exclusively been buying interstate, which has worked out really well for our clients. But as Tim's touched on, we are starting to see the data show a real opportunity here locally in Melbourne and Victoria.
Yeah, I think it comes down to your budget, what you can afford, but you shouldn't have your blinkers on and not look at opportunities interstate. I think that's madness.
Well said. I think you should have a portfolio that includes different states around the country because different states peak at different times. You mentioned reviews. We've had investors in Tassie, Southeast Queensland, Victoria, Perth, Adelaide. So we actually go exactly where the market and where the data is suggesting we need to put investors.
You do meet so many clients that come in and want help buying an investment property, but put a restriction on it that needs to be somewhere that they can drive past it and look at it.
My dad was a guy. So my dad had 3 properties in Taylor's Lakes. We lived in Keilor, and I said, why? My dad used to drive past and wave at the properties. And I said to him, have they ever waved back at your dad? He goes, no. But it was the guy that did his own maintenance. Yeah. I wish I had the knowledge I had now when he was buying him. He would have bought more, but that's what he was comfortable with. I still believe his strategy is better than no strategy. So well done, Dad. Timing the market, is that important or overrated?
Very important, very important. So as Tim said, I think obviously timing the market is true.
So timing the market. So waiting or getting in, timing the market.
But I think timing the market's really important because if you don't do that, it's going to really stunt your growth and hold you back from being able to grow that portfolio quickly.
Yeah, as cliche as it is, it's always a good time to buy real estate. Get in wherever you can at the budget that you can afford, but aim to keep that asset long term.
100%. Get the advice before you look at investing. Don't go look at areas until you understand what you can and can't do, and then look at properties. So most people's strategy, flip it upside down. Look at your borrowing capacity, look what it's safe to do, then look at real estate options. Is a cash buffer essential or optional?
I think it should be essential.
Essential.
100% essential every time. Do you think negative gearing is a good thing or a bad thing?
Good thing, personally.
I can tell you, without it, this country would be in dire straits when it comes to housing. Like if we didn't have the ability to be able to maintain mortgages through negative gearing, then we'd have far less rentals on the market, and that would be a disaster for humanity here in Australia.
I hear, don't spend a dollar to save 50 cents. Look at what that negative gearing is doing to your overall net worth and your wealth and paying off your mortgage. So definitely a good thing.
To quickly touch on that really quickly as well is that people often talk about positive and negative gearing in terms of the real estate. And I think it's a bit of a misconception by people that it's got to do with the real estate. It's actually to do with your leverage. Is if you put down a 50% deposit, nearly every property is going to be positively geared. So it's a choice to leverage it so that you can focus on paying off your own mortgage and get some tax benefits that will help you grow.
Or if you're an investor, less risk, more opportunity. So if you want to put a high deposit, that's great. You'll build wealth, but it'll be slower. Or you at a higher LVR, you'll build wealth quicker, but it will also increase your risk. So again, it comes down to having that discussion.
Well, you look at obviously supply issue and housing is a massive issue in Australia, and how we're going to help that is build more homes. But you look at investors, if negative gearing is not available and not able to claim that depreciation and get some of that tax back, how are we going to get people to build more homes here in Australia?
100%. But people just investors would choose a different asset class.
Yeah. When I hear, will they ever scrap negative gearing? I know it's quick fire question, it's such an important question. I physically don't think they can afford to do that.
They can't.
That would turn this country on its head. It will affect
They've tried it in the past and they have to reinstate it. Simple.
I don't think we can afford to do that. But for that slim chance that anything can happen, they'll grandfather it, they'll change it. You've got to roll with the punches. I don't think we can. So it's always customary on our podcast. On 1 to 10, Locke, how much have you enjoyed being on it?
11.
11. Kimbo?
20.
Welcome back. Now remember to like, share and subscribe to see more Reventon Property Podcast with some amazing guests. Looking forward to seeing you next.